This is Dentist Money. Now, here's your host, Reese Harper.
Welcome to the Dentist Money Show, where we help dentists make smart financial decisions. I'm your host, Reese Harper, here with my trusty old co-host, Sir Ryan Isaac.
Buenos dias.
And he's a multi-literate Ryan Isaac.
Multi-literate?
That's a thing.
Yeah.
Two language.
I think you were looking for bilingual.
All right.
It's like a game show.
Kicking this off on the right foot.
The answer there you were looking for was bilingual. Bilingual.
The host is supposed to be elevated. You don't make the host look dumb on live radio.
Live radio, you're right. You can't look dumb in a skinny black tie, white shirt, black pants day, though.
It's a Ryan Seacrest day.
I like it. Ryan Seacrest, you look like you came out of a ska band.
Yeah. Yeah. Oh, I play
like the horn section of a ska band.
I play the trombone in a ska band.
And you skank when it's not your time to play?
Yeah.
Is that you skank?
Yeah. For those of you who don't know what that means, the skank is a dance that ska bands do while playing ska music.
What is ska music?
Ska music is probably the most popular musical genre ever invented. It was primarily popular during the late 20th century. The 1990s.
Well, most people didn't know that Abraham Lincoln had a ska band on the side.
He did. The tone was a little different.
It was like the Lincolnator and the Abolitionists or something.
Yeah, many of you will listen back to this podcast and remember the days that you're introduced to ska music.
We're just grateful for you listening.
We can point you to places like Less Than Jake.
Real Big Fish.
Real Big Fish. We can
Mighty Boss Tones.
Mighty Boss Tones.
Can put you onto the Boss Tones. You could find yourself listening to we'd consider it some
Goldfinger.
Yeah,
for
little
sure.
Goldfinger.
Some classic Goldfinger.
America gave us two things: the Constitution and ska music in the 90s.
Okay. With that, we're going to talk about risk today in your investment portfolios.
Yeah.
It's perfect segue.
Yep.
But before we get into risk in your portfolios, and the topic today, and we've been talking about this in the office lately, is how do you measure this? Like how do you measure someone's risk? How do you give them appropriate guidance? That's a big topic in our industry too. There's dozens of companies that build software just to test how risky someone should be in their investments and what kind of investments they should choose. But we recently we did something that reminded me of choosing risk in portfolios and why it seems a little archaic.
Okay,
is we took a company trip, kind of. Some of us did.
Yeah,
and we rode mountain bikes at Deer Valley Resort in Utah, Park City, Utah.
I wanted it to be more of an all-inclusive trip for the company, but some people don't have preferences for going down mountains at high speeds and putting their life in jeopardy.
Yeah.
And so it's difficult to make that one be a company activity, but a third of the business was there.
Some people went. I think there's a lot of stories on risk up there because I went up there and I have probably a $60 helmet.
Yeah.
It says shred on the side of it, so it's pretty serious.
It says shred, but it clearly does not
evoke
shredding.
There's no feelings of shredding with my huge weird helmet.
It kind of looks like you went to Walmart and got your helmet, but then put shred on it.
Yeah,
and
like a shred decal.
Yeah,
I think there's.
We call it a cross country helmet.
It's pretty cross-y. I have fingerless gloves, which always make me think of like a dance-off in a back alley, which we also discussed. I didn't know we showed up. People have full face helmets.
You're getting into the sport, though.
And they have neck braces. Braces. Yeah. What are you doing on a bicycle that requires
full body armor?
Armor?
Yeah.
I mean, I just felt really unprepared for the risk I apparently was taking as we took 2 lifts up to, was it 8,000 feet?
No, we were closer to 10.
Okay.
Yeah.
2 lifts up to 10,000 feet. And then they're like, there you go, kid. And everyone else is full head to toe prepared.
Yeah.
I have fingerless gloves, some thin cotton gym shorts, and a Walmart helmet.
And on the way up, you looked down below us and you saw multiple people like,
oh my gosh,
almost going to the hospital.
No, we did. Justin actually heard secondhand the story. The guy we saw under the lift that was being carted off, Justin heard about it from a secondhand source. The guy was unconscious next to a tree.
He didn't realize that a cross-country helmet and no body armor it's not the appropriate way to prepare for
the risk
tsunami.
of a black diamond downhill
Tsunami is a 30-foot tabletops, massive drops,
big gaps,
huge gaps, and this person was riding a bike that wasn't prepared for that, and they did not have any appropriate gear,
t-shirt,
and they had
shorts,
never,
and
they had never
cross-country
ridden
helmet.
this kind of trail before.
So like me, so here's what it got me thinking about this when we were talking about risk and portfolios. I was thinking about that ride. It's the levels of what do you call it, of expertise in the rides are kind of marked like ski resort. Like it's green, then blue, then black, then double black, right? That's how it goes. So we started off in some greens, the holy roller.
Yeah.
And they're just kind of some rolling niceties, but you pick up a lot of speed. I was a little scared.
Yeah.
For holy roller. We did that twice. But then on the third run, we said, I think we're ready for blue.
Yeah.
And I felt like blue in this, we got green, blue, black, double black. I felt like that's probably a fair indication that I'm ready for a blue. It probably clearly denotes the risk of what the trail is going to be. You know, the green was flowy. It could go fast if you wanted to. The blue, you said, had some jumps.
Yeah.
Right? That seemed normal to me. What did we find out in the first 30 seconds of that stupid blue, though?
Well, this is a good point. I didn't realize that this blue was aggressive until I went down it again and was reminded by the people falling behind me off of the edge of the setback.
But if this was a portfolio, this would be like conservative, moderate would be the blue. You'd have like aggressive and then aggressive growth. This would be like the moderate portfolio. Yes. And I was like, holy crap, 3 out of the 5 of us here are going to die. Your son turned around and went back down the lift after he broke his bike on the first turn.
Yeah. I felt like that was the hard thing for me I had ridden this so many times. I was more tolerant of this risk level of trail that when I stopped about, a few hundred yards down, just hoping that there was someone even coming back behind me. And I was like scared there for a minute. So I was like, oh crap, this is, and it wasn't like, it's not obvious to me because I had a lot more experience with riding than some of the riders on this trail.
2 of the 6 of us had experience riding.
Yeah, on this trail. Yep. And I felt like this was the middle ground run, and it wasn't quite the same risk level as I assumed.
I mean, it was seriously the same as saying it's a moderate portfolio, but like you had 50% losses in it. You know, it was pretty crazy. Anyway, that experience reminded me about how hard it actually is to choose how risky of an investment portfolio someone should do, because the way that, I mean, what's the normal way in our industry that people figure that out on how much risk to take?
Well, the normal way that it happens is you fill out a stupid questionnaire that you don't really understand very well, and you make some guesses at it because your financial advisor is just like, fill this out and then I'll tell you what to do.
Because legally, you just have to.
Because legally that helps
me.
Protect some financial advisors because they're like, well, you picked it. And so it'd be like me telling Ryan, like, I'm not responsible for you dying on this trail, you idiot. You picked it.
Those are so steep.
And he'd be like, you took me down this trail,
and it was the lower end of the portfolio. It was the blue. It wasn't black.
And so, I mean, that's how it typically happens. You'll fill out a questionnaire. This questionnaire will give the advisor an estimate of risk that you should be taking. And then they will, actually, not an estimate, but it'll like map your answers to a portfolio, and then they can, sadly, in many cases, they can just say, you picked this. This is what you said you wanted. Remember?
Yeah. And
I'm not saying everyone's that.
So in preparation for this, I was curious because I've seen some of the big ones, but I went online and I did lose count, so I can't make up a number, but it was over 10 quizzes that I took. I found them from huge reputable companies. Some of the...
Okay, so you went and did it for this podcast.
Yeah.
You went and said, I'm going to invest in an experiment for this show.
Name a large financial institution or a fast-growing tech-based app that manages your money. I took their risk profile questionnaire.
Merrill Lynch.
Yeah, yes.
Betterment. Wealthfront.
Yes.
Wealthfest.
Yes.
Interesting. Robinhood.
No, I didn't take Robinhood. New York Life, Vanguard. You said Merrill Lynch. All the big ones.
So 20 things you took. What happened? What did you learn?
There's no consensus.
Really?
That's what I learned. It reminded me of riding a mountain bike down a blue And everyone's like, the blue's at the lower end of things. And it's a wide range of experience down that blue run. That's what it reminded me of. For example, okay, the definition of a long time frame ranged anywhere from 7 years to 20 plus.
Whoa.
So do you need this money in less than 7 years? That was like considered long for some questionnaires. Others were 20, and they were 7, 10. One of them was 11. One of them was 14, then a couple 15s and a couple 20s.
Yeah.
So that was weird.
Very weird. You can imagine if you're an investor and you're see, the reason this is important is because these surveys will spit out the amount of stock that you should have in your portfolio based on what you kind of consider a long time frame to be.
Well, it got harder than that though too. So the time frames were kind of weird. There were the questions were all over the place. So they'd be like, some of them were describe yourself, and they'd have these really extremes in answers. Like, how do you view the stock market? This is one of them that stuck out. How do you view, what's your view on the stock market? One of them was like, it's a casino. The other one was, I like to play it. And the other answer was, I don't know, but I'm in it. And that was supposed to tell me something about, casino.
So depending on the one you pick, like any one of those three would make you look like an idiot if you picked it. Like all those are dumb answers. So no one's going to be like, yeah, the stock market's a casino.
Or if you got an unexpected inheritance, would you put it in a CD, a hot tech IPO, or a single blue chip stock?
All stupid things that no one would pick.
Don't do any of them.
Like, I don't know. Like, I don't even know what blue chip means half of the time.
So my results came out in balanced to moderate. That was my range. And every website and every quiz has a different answer on what you are. So you're either this word they make up, could be balanced, could be moderate. I was anywhere from 60% stocks to 80% stocks allocation. Let's see. Some gave ranges of expected returns. Like, you're balanced to moderate, so you should expect anywhere from a 6 to a 14% return in your portfolios.
Real helpful.
Yeah, it was really hard. So then another confusing thing that you were saying, some of them gave specific, here's how much stock allocation you should have, and then some of them click on the advanced tab. And the advanced tab would then break down how much should be domestic, how much should be international. In the most aggressive, advanced versions of all my test results, the highest allocation to international equities was like 12%.
No way.
Even though
so it's like a third of the market cap. A third of what the world actually is.
Half of the world's market cap is outside of the United States.
And you're just like, no, we're not putting our money in there.
My most aggressive recommendations, if the website got that much detail, was like 12%.
Which it rarely did, probably.
Yeah, which it rarely did. I found two quotes. One of them was from Betterment, actually. This is really, really good information. They said, these questionnaires measure what kind of risk taker you think you are, not what kind you need to be in order to achieve your goals. I thought that was really interesting. Like, we're kind of like doing this self-assessment on like, I think I'm and everyone always thinks not everyone, most people think they are riskier than they really are.
Yeah.
And it's not usually in relation to their goals. And then another website said that the rational Dr. Jekyll fills out the questionnaire, but the emotional Mr. Hyde controls the investing. So my first thought I want to talk about today is how people define risk in their investment portfolios. Like I think it's a huge misconception. So that's the first thing I would ask you is, how do you think investors define risk? When you say risk in your portfolio, what do you think most people are going through their heads?
The only thing they're probably thinking about is losses, like downside, like how much my account's going to go down or possibly could.
Like volatility.
That's what they're thinking. They wouldn't know what volatility means, but we do. But if you explain it, people would know. But they would just think like, tell me how much this could go down.
How much it could go down. Yeah. Whether I sell it or not, how much could it go down?
That's when they say risk. They just want to know, will this go down?
Yeah.
Like there's some like expectation that there might be something they could invest in that wouldn't go down.
It goes up.
They're like, yeah, it'd be nice to get 7% a year. I don't want it to go down though. And there's this idea that like that's a thing.
Uh-huh.
that like there's a thing you could invest money in that wouldn't go down.
And you should know what it is.
Yeah. Well, I mean that if you don't, like that's like what value do you provide to me? You're a worthless financial advisor. You don't know how to give me something that doesn't go down.
Yeah.
But if you think about like any business in the world or any company, any dental practice, do you really think that there's like a likelihood that your business never could go down? That like there's no scenario in which it could go down, that companies wouldn't change price. They just go up all the time. Because if they just go up all the time, then what they turn into is CDs. I mean, they turn into like things that have no value. They don't pay a return. So the CD doesn't ever go down. So it doesn't pay you.
That's a really good point about the. You think about the amount of time dentists can spend thinking about if their investment portfolios or the stock market specifically can go down. But think about the biggest risk they ever take. You know, you've got 10 years of your time in school, hundreds of thousands of dollars in student loans, maybe $1 million later in practice and equipment and building loans. And so one of the biggest things they'll ever undertake, and how common is it that over the life of that asset, it actually ends up just being worth a lot less money than it ever was at its peak. You know?
Totally.
One of the biggest and riskiest things a dentist will ever own, their own practice, it's really common to just see a steady decline before they eventually exit.
You took all of these risk profiles, and the average thing that came out online was like you're moderate to balanced, or you're balanced to moderate. And what I found in my own experience is most people never want to be at one end of the extreme of a spectrum. They're like kind of searching for middle ground. And the only way that they will go at the end of a spectrum is if they're hyper educated about the ends of the spectrums. Like if they really know why they fit at the end of those spectrums. Because if they don't know why they fit, they just end up opting for the middle option in a lot of things in life. You know, you don't want to come across as an extreme person. You want to come across as a moderate and independent. It's like really popular right now to just be like, not take a position that's extreme and, you know, not have a strong opinion that offends anyone, right?
I feel like that's all that's online.
Yeah.
It's these extreme opinions that offend everyone.
And it's like, online is very different. Social media and online, there's no identity. You just ramble on and don't have any like consequence.
Dunning-Kruger effect.
Yeah. But if you're like standing in front of me and talking to me about your life, you're not going to be like, I'm like the worst person ever. I never exercise and I'm going to die. Like you're never going to say that, but you're also not going to say, I like have the best exercise habits of anyone and I'm doing like amazing and I'm killing it. You're going to say, well, I'm trying, and explain, what you're doing. And because you don't want to be like the worst person, but you don't want to be the best. And I think anytime you have a spectrum that's presented to you, you're trying to like on one side be, temper. You're just trying to temper like who you are a little bit so that you don't come across as extreme. And that's why I don't like the investing like risk profile spectrum. I don't think it's a healthy way to think about it, because it's like no one's got one risk profile that says you're this kind of risk taker. It's really just about educating yourself about what bucket of money should do what thing. And if that thing is what I should do with that money, then I will do that, And so if I say that you've got an account that you're going to put money in, you're going to get a tax deduction for, but we don't want to touch that money till you're age 70 and a half, because that's when ideally it would make the most sense to take it out. And let's try to build up your financial plan to allow us to let this account be left until that age. Then what if I told you that the highest return we could possibly get is by owning only stocks in that account and having it be invested in a really diversified way and trusting that over that 20-year period, that account's going to grow a ton.
Yeah.
And by any amount of bonds that we mix into that, or any amount of safe investments that we mix into that, all it's going to do is make your return lower. It's just going to make your return lower. Do you want your return to be lower, or do you want your return to be as high as it possibly can be?
Because you don't need this money.
Because you don't need this money for 20 plus years. If I give it to you in that context, you might say, well, I want my return to be as high as we possibly can, as long as I have an emergency fund, some fallback money, and I know that, I've got other
Despite
investments.
the fact that even a really advanced questionnaire might have told this person that they shouldn't hold only stocks.
Yeah, despite that a questionnaire would have said you need to have a 60-40 mix.
Yeah.
And then the person talks to their advisor. They end up picking a balanced portfolio. And throughout your career, it costs you $1 million in lost returns because you didn't expose your money to the asset class that could have given you the optimal return. Now, does it have the most volatility? Does it move up and down the most? Of course it does. Just like a dental practice or any other private business ownership, it's the most volatile thing you could own. But if we're going to sit around all day and keep our money in kind of like happy medium land and not make a choice about what we really want to do with it, then we end up just having lower returns over our lifetime, and that costs us net worth. Now, I want to say that generally speaking, the experience you had going online and filling out 10 questionnaires and getting an answer of like, you're a balanced investor. Yeah. If you look at almost all investor portfolios across the country and you say, what does the like risk mix look like? Yeah. It's like right in the middle. Yeah. Right. It's that way because a lot of us are picking portfolios that are right in the middle. But it's not that way because some of us are on one side of the end of the spectrum and the other side are not on the. It's not because some are only owning bonds and some are only owning stocks, because a lot of us are picking these middle of the ground portfolios. But I just don't think we really know the difference between when I should use a stock and when I should use a bond. Yeah. Like I'm going to get a lump sum of money in the next few days that I have to sit on for a little while. And I got to decide, do I spend that on this upcoming purchase? Do I spend it on the company? Do I invest it in for my own retirement? Like I've got a lump sum coming up. I've got to make a decision on that. So if I have that choice to make, I can be confused about it, and I can be like, well, I don't really know, so I'm going to pick a middle of the ground portfolio. Yeah. Or I'm going to say, well, no, it's for this purpose. You know, because I know
in this time frame
that I probably will. Like for those of you who own a business, you're thinking, am I going to need this for the company? Am I going to open a second location? Am I going to hire someone? Am I going to expand and grow? Am I going to add more equipment? Am I going to buy real estate? If the answer is yes to any of those questions, then you have to carve out the specific amount of money that you need for those tangible goals and put it aside and don't invest it. Mm-hmm. But if the answer is, well, there's this chunk that I don't currently know whether I am ever going to need it until way down the road, then invest it as aggressively as you can, because if you know you have at least a 10 to 12 year plus time horizon before you'll need that money, then don't sit around with it in a conservative account. Yeah. And I find that just too many people, when we ran this report this month, it was really eye-opening to me. I've got some clients who are they're just hyper efficient with how their portfolios are structured in terms of if they've got a goal that's short term, I mean, they've got it in fixed income and it's really targeted, but the rest of their money, they are in all equity and they are growing great, you know? But they're very volatile portfolios. And I've had to work through for years with these clients on struggling with those emotions of how they feel when their account goes down. And I know in the next couple of years, I'm due for another one of these moments. Yeah. But man, the clients who are really precise about their investment goals and allocate them to the highest risk they can tolerate for the goal that they have, and not making your portfolio just one cluster of a risk profile, but really identifying the portfolio timeframes for each bucket of money and then aggressively investing that. Mm-hmm. I mean, it makes a big difference, Ryan. I mean, it's millions of dollars in net worth growth. And it's the same money. It's just like one person was willing to do the hard work of saying, I'm going to have to expose this to more volatility. Yeah, I often talk with clients about the real actual cost of participating in the stock market or public markets. It's not the cost of the funds nowadays. It's not the cost of outsourcing to an advisor. The real cost in it is that emotional and mental roller coaster. Yeah, that's it's a real price. One. It's not easy. It's not the price people think they're paying, though. But that's the real cost of getting, if you go, oh, the S&P 500 over 20 years gives me 10 to 12%. Well, if you want that, then the cost isn't the price of the ETF to capture it, or the cost to outsource to someone to just do everything for you so you can just keep doing dentistry. The real price is the fact that S&P 500, if that's what you're getting, will fluctuate wildly. Yeah, and that's why I'm a strong proponent of having an advisor, because I do think that people are able to achieve a higher return when they're working with someone who encourages them to to take the appropriate level of risk. In most cases, more risk than you'd be willing to take without them.
Yeah, and we know that that's the case with a lot of dentists just because of how many people we meet that are sitting on multiple six figures in cash in a business account.
Yeah, for decades.
Yeah, for a long time.
It's like you've been sitting on this money for 8 years.
But what's weird though is then you'll see the 401k that was set up by someone like random years ago, and it's just like concentrated terrible portfolio in, 2 sectors of the economy, like hyper aggressive
energy and gold.
And then like nothing else, like this hyper concentrated, really overly aggressive, overly risky
And that's
portfolio.
just a bad, well, if a dentist did that, that's just, that's shame on you for doing that. But
I don't think they do.
If a financial advisor did that to you, shame on him for doing that.
Yes.
But in most cases, it's an advisor doing that.
Yeah, setting
or just saying, yeah, that'll work. That's a good idea.
That sounds like a good,
But it's something that I feel like no one listening to this podcast should ever be in one sector or one stock inside your 401k. If you do that, you're not being smart with your money. It's not like a preference or like, I'm just kind of like, I think I'm just going to take a little more risk. When you do that kind of a thing, you're not taking more risk. You're just like gambling at that point.
Yeah.
Like you don't
That's not
speculate
how you take more risk.
on a stock. You don't speculate on a sector. When we're talking about exposure to the market, we're saying there's 13,000 stocks in the world. And if you owned them all in some set of indices that were proportionate to the size that they were in the world, that's the right way to build an index portfolio.
And if you want more risk, then just hold less fixed income and cash.
Yes. And I think there's a place for fixed income and cash. There's a huge place for it. And that stability of that, like just bedrock portfolio, it will give you the mental bandwidth to take more risk.
Yeah.
For example, let's say we start out with someone and they're a 50-50 mix. They've got $250,000 and they're going to invest that money. You got $125,000 in stocks and $125,000 in bonds. Well, that person basically has, at $125,000 in bonds, they've got a 1-year emergency fund sitting there to offset their living expenses for a year.
Yeah.
It feels really good at that point. I mean, you feel pretty conservative.
Yeah.
When you get to 400 or 500,000, you don't need to continue
2 years
to
of living
have
expenses at 40 years
2
old.
years of living expenses in bonds. 1 year's still enough. You could have more stock. And as you gain a larger and larger portfolio, you can afford to have more and more and more equity exposure because you're more liquid. Even if the market goes down a ton, you could still go get money from your equities. But once you get to the point where you're, what we've talked about in previous podcasts, we call it a 30 TT score, a multiple of 30. The larger you are, in terms of your net worth relative to your spending, a TT score is something we calculate by just adding up all your stuff and dividing it by your annual spending. If it's 30 or more, you could continue to still take that kind of risk or that kind of volatility because, man, you've got a long runway of liquidity that you can pull from. And even if the market goes down 40 to 50% over a 2-year period of time, you can ride through that.
Yeah, you can get through it.
And you'll be fine. But you don't have to do that. You don't have to. You can have that same amount of money in a much more conservative account. And a lot of people will find that that's just a more comfortable place for them. But your advisor should be, just like a good physical trainer or a nutrition coach, your advisor should be pushing you to stretch yourself. And stretching yourself with investing is taking more risk with more volatility. That's stretching yourself. Not going more conservative and saying, you know what, I just don't want. Like that's the opposite direction of what will make you more money. And so I think a good advisor is constantly trying to help you push that risk profile just a little bit further than you'd be naturally able to do on your own.
Yeah, I think that's just one of the good points to make is, okay, so if I took a dozen questionnaires and none of them gave me like good direction, because it's all really vague and it's one size fits all and they all kind of spit out different answers. What is the better way to help someone measure risk though? You've started talking about this. If it's not you, which it's not likely going to be, you need someone who has an incredibly detailed, organized picture of what your life is like.
Yeah, how would you do that with people? You do it every day.
We do it every single day.
Hundreds of times.
Hundreds of times a day. Well, someone, if everyone listening, if you go to our website, you can see what we're talking about, this framework on how we view someone's entire picture. Go to dentistadvisors.com, hover over the services tab, and then click on elements. And about halfway through the page, you'll see this table Looks like ye old chemistry table of doom. And there's
12.
OChem.
It's back to the OChem days.
Oh, and there's 12 bricks there. There's 3 on top, 4 in the middle, 5 on the bottom. And they're broken up into the 3 sections of risk you take in your life, in investments, in practice, and insurance. The 4 in the middle are the 4 categories of where your money goes: savings, spend, debt, taxes. And the 5 on the bottom is your net worth. It's how liquid, retirement plans, practice assets, real estate, and then all of them added together is your total term you're talking about. So when we're talking about getting someone organized, that's the framework we view it. That's the lens we're looking through, is I can tell someone what their portfolio should be if I know what those 12 bricks are telling me, you know?
Yeah.
How much of their net worth is sitting in real estate that's not liquid.
Yeah, so when would you tell me like how much risk I should take? Like, how do you make that decision with me given that context? You know my wealth, you know how much I'm worth, you know where I'm spending my money. How do you coach me to know how much risk I should take?
Yeah, and part of that too is then like knowing are you the dentist who is one doc, one location, and you're 3 days a week and you're just trying to get the most profitable, the biggest you can get, and that's where you're ending? Are you the guy who's pushing for 10, and you need to constantly pump more capital into your business? Are you do you hold real estate? Do you hold buildings for your practices? So getting to know the person too, on top of all that organization, like what do you even want out of your life and your career, will tell me a lot about how we need to prepare. Maybe the cash balance plan and the 401k is extremely aggressive because it's not money we can get at anyway, and you're 40, we're not going to touch that for 30 years. But your after-tax portfolios, they might need to hold some bonds.
Yeah.
Because I know you're going to have to, you're an entrepreneur, and a third location is going to come up at some time on your radar unexpectedly. You're going to want to jump on it, or the building is, or maybe you hold a whole separate account that's very liquid, very conservative, very short term, just for that purpose. And we try to estimate, all right, what could be the price of the building in your area? What would the down payment look like? Or your wife wants to move to the new home that you're going to build, and you're going to need a big down payment for that and for the lot. Just knowing someone's goals on top of all that information, like knowing who they are, what they're driving towards, will help us create a lot of that too. And that might end up being very different than what the questionnaire tells you.
Yeah.
Like totally different, I think
that's a great insight. Just the fact that you're not answering, you're working with your clients and you're not saying like, what did they spit out in the risk profile? That's what account I'm going to put them in.
Yeah.
You're saying I need more context. I need more information, because clearly a 10 questionnaire from a risk profile is not enough information for me to make a recommendation.
It's not even specific to a dentist. That's very different than the corporate executive sales guy with the salary and the 401k plan.
It's like, well, the 401, if you're answering this about my 401k, you're answering this about my entire risk profile. And that's the point I was trying to make earlier, is like with a dentist, it's like, well, risk is not, we're not talking about like one dimension of risk here.
Yeah.
You give me a risk profile and I'm filling it out. Like, don't expect that tells the comprehensive picture of who I am.
Well, this makes me wonder, should we fill out, a dentist might have 6 buckets of money.
Yeah.
So are we supposed to fill out 6 questionnaires and then repeat it every year?
Well, that's what I've told. That's what I've told. See, in our business, what we've consciously done is, instead of having the client fill out one risk profile and have that be like the story of their whole life, which is honestly, you need to know that that's what a lot of your advisors may be doing right now. Their assumption about the way they invest your money is driven by a profile that you filled out and probably did not know how much that was going to affect your future, like how much your returns would be affected by that.
Are you surprised when you see portfolios that are 100% equities and you're like, that guy's personality is not going to deal with that well?
Yeah, well, it depends
on
the
reverse of that.
Yeah, I'm always surprised that portfolios do not usually match up with what I think people want their portfolios to do.
Yeah.
What they're hoping to get out of their money is not the way that their money's invested.
It's structured. Yeah.
And I think the best way to go about doing this for me though is there needs to be a fundamental belief that the advisor is really trying to discover what will work for someone over a long period of time. What is going to work for you as an individual? What will you not walk away from? What will you not stop? What will you not quit? What will be the most sustainable plan for you? And each person's going to need a size of an emergency fund, we'll call it. Now, these emergency funds we're talking about are invested. They're invested. They're growing. We're just talking about a more stable baseline return It's not invested in the stock market. It's going to be fixed income, corporate debt, municipal bonds.
Not sitting and checking.
It's not sitting and checking, but everyone's needs a certain size of that to be able to take the appropriate risk they want in the other areas. So for some of you, it's going to be taking risk with hiring associates, expanding your practice, multiple locations, a DSO kind of goal. Some of you, it's just like, I want to get my practice to where I'm producing myself, no associates, to where I'm doing $1 million in collections or $2 million in collections. In order for you to take that kind of risk in your business, you're going to need a certain size of liquidity, a certain emergency fund, a certain amount of fallback cash that's invested that you know you can count on, that allows you mentally to take risk in that practice, that take risk in that business. And the bigger your goals get, and the bigger your goals get within your business, the bigger that fund needs to be. And only like I because I have a fair amount of confidence in where my business plan and maybe the experience I've got with investing, maybe my personal liquidity bucket could be smaller than someone else's to have me feel okay and feel like I can do this.
You're saying based on your experience and your level of knowledge.
Yeah, level of knowledge, and maybe my level of confidence in the plan I'm going to
so maybe
do in my business.
You could have a slightly less gear on going down the blue run because you know what's ahead of you and you know when to slow down a little bit and when to speed up. You know how to take jumps. I have no idea, so I should be head to toe geared up.
Totally.
Okay.
And until you've had 50 runs down that run and you kind of know, okay, you're not going to be negligent and you're not going to not wear any helmet.
Yeah.
But maybe you can take off the
chest plate,
the bulletproof gloves and the bulletproof chest plate and pants and steel-toed boots.
Yes.
Okay.
I mean, seriously though.
Like at some point you can dial it back.
Because I know what a switchback that's like pointing straight down feels like. So I have no idea how to navigate.
And what I do like about the way the industry, what the industry has done right is we've created two financial products, a stock and a bond, that basically accomplish what I'm talking about. You can have something that's safe and predictable that gives you yield and still makes you a great living in a bond, or you can have a stock that gives you a lot of long-term growth. And you can mix those two things together to create different outcomes. And it's really an awesome financial system. It's amazing that we have that companies can raise capital this way and that investors can invest that way. But if every investor has a different mix of those two extremes, some people are not aggressive enough and need to be pushed, and some people are ignorantly too aggressive and they need to be pulled back and need to be given more liquidity because they're going to implode. And you hear that story all the time. I hit retirement, I was 65, but my 401k crashed. Well, what were you doing in stocks the year before that market crashed with all of your money?
Yeah.
Like you didn't have any fallback cash, no emergency fund. If you knew you're going to retire,
12 months
then
out.
That's just bad planning.
Yeah.
Like that's not the stock market's fault.
Yep.
I hate hearing that because it's like, well, the stock market,
the big casino,
killed
Reese,
me. I'm like,
Reese,
what
how
were you
the casino
doing
works
with all of your money in stocks that far away from needing it?
Yeah.
You know? That person did not have this fallback reserve we're talking about. If you have all your money in stocks, you better have a 3 to 4 year bucket of safe money, because that's the market could be imploding for that long. And you should not be all exposed to equity. Throughout your career, all I'm saying is that most people don't have quite enough equity exposure during their accumulation years. They're too conservative. They don't grow their capital well enough. They leave a lot in cash and they leave a lot of returns on the table, and their net worth hurts because of it.
Yeah.
And then later on in life, when people didn't accumulate enough and they didn't save enough, they're too aggressive because they're trying to make up for lost time. And so a lot of times in your later years, people are taking more risk than they should.
Yep.
And those are the things that a financial advisor is trying to get to, helping you take more risk when you should be taking it, and less risk
when you should not be. So let's I kind of want to go back then to one of the first things we started talking about is what should the definition of risk in a portfolio, like what is well, I looked this up in the dictionary, and the actual definition of risk is a situation involving exposure to danger. So my question then is, what's the real danger in a portfolio? Is it
a great question.
Is it that it goes down?
I mean, this is a little sophisticated, so pay attention. It's going to only be 1 minute of this.
Pack a lunch, kids.
Take the amount of the percentage that you need to withdraw from your balance, the percentage, that's the danger. If the percentage that you need gets too big, you're in a dangerous location. For example, let's say you have $1 million and you're going to withdraw $120,000 a year out of that account. That's a dangerous place to be because that's 12% of your balance. If you're withdrawing 3% of your balance or $30,000 a year, it's not a dangerous place to be.
That's the real danger.
That's the real danger is what percentage of your balance do you need to withdraw?
I like that.
Because if your balance, if the percentage you need is high, then you're in a dangerous situation. And you probably should not be aggressively invested because that money is going to get spent really fast.
Yeah.
And you shouldn't have it exposed to capital markets.
Yep.
If you're at a 7 or 8% of your balance that you're going to need, then you definitely don't want to have it all in stocks. I mean, there could be some periods of time where
for sure,
where we have a bad stock market 4 to 5 year period, and because you needed that much money out, imagine if you start out retirement at $1 million and your account drops 40% because you're all in stocks. It goes to 600. When you started, you only needed 70 grand a year. That was 7% of the million. You still need 70 grand when it goes down to 600. But that's like over 10% now. You're 12+% in because the market's down there withdrawing 12, and you're like, holy cow, I'm withdrawing 12.
Yeah.
So when we say you can be withdrawing 3 or 4%, we're saying, well, that's because if the market goes down, you'll be withdrawing like 5, and 5 is still sustainable. 5.5 still sustainable. So the real risk in my mind is if you're not planning on withdrawing money for more than a 10 to 12 year period of time, you should be growing that capital as aggressively as you possibly can.
Yeah, because that's enough time to let things
go.
cycle.
If you know you're going to be withdrawing money from that account, the moment you know what the dollar amount is, the moment you can start seeing it. And a financial advisor, that's what his job is planning that all the time, knowing what you spend, how you spend it, the way you like to travel. It's his job to just observe your spending through a good spending tracker and kind of say, this is the way this person likes to live. And I'm going to calculate and build their portfolio to match up with that spending.
Yep.
And we'll take the right amount of risk for that withdrawal that we know is coming. That's a good financial advisor that's doing that much work. But it's not a good financial advisor who's spitting you a survey, taking your answers, and then putting your money in it and hoping that when you get to retirement and you complain about it, and he just looks at you and says, well, you filled it out. You filled it out this way. It's like,
or when you said, I want to take
bud.
more risk, and then they just double down in oil stocks.
Yeah.
And you're
like,
like,
take some more risk. Well, let's go into energy then. All right.
Let's put 70% of our portfolio in energy.
Just get crushed for 7 years.
So I think that's a really good explanation of what the what the real danger is. Now we measure that in something called total term. Justin, where can people get the total term guidebook?
Yeah, so if you go to that elements page that you were talking about, in that periodic table, you'll see TT is one of the bricks that you can click on. If you click on there, you'll see how to download the TT guidebook for free.
Yeah, so dentistadvisors.com, hover over services, click on elements. Halfway down the page, there's the bricks. You can hover over TT. It's green, bottom right-hand corner. It'll pop up a little modal dialog box for all you coders out there.
Yeah.
And then you can click the little download. So the TT guide is what Reese is talking about, is how to measure where you're at in terms of what's the danger you're going to have of running out of money. Here's the other thing I thought about when reading that definition of risk, which again is a situation involving exposure to danger. I kind of just recalled things like what Vanguard publishes, or a dozen other studies. I read one from Morningstar last night where they were saying investors' self-defeating behavior, such as selling at the wrong time, cost them anywhere from 1 to 2.5% every year. Vanguard measures it's about 1.5% in behavioral problems. So I hear that. I like the way you explain it with like withdrawal rates, and how long is your money going to last and that danger. But then I think about the real danger is people just reacting emotionally to a down market.
Yeah, I'm assuming in my example that everyone's going to be similarly rational, but that is not
it's very academic of you.
Like, I could argue from my perspective why a risk profile is completely fine given this math that I'm telling you. But there's a side of many people that will just like not trust math in that moment and just be like, I do not care. Like,
what
it's different this time, Reese. I don't care
because X, Y, and Z, the news, my friend, brother-in-law, my
X,
dad.
Y, Z, it's different this time, and I'm just not willing to do that. And if you end up doing that to yourself in the middle of a bear market cycle and you self-capitulate and you walk away from your strategy, like you kill your long-term financial returns.
And that is danger.
You're just flushing your net worth down the drain in a predictable way.
Yeah.
So do not do that to yourself.
So I think that's fascinating because, you spend some time talking about getting to know someone so well that you can mathematically tell them, look, you're not touching this money for a long period of time. You can afford to do this. But you also know as an advisor, if you work with someone who really knows you, who you communicate with frequently, okay, not one meeting per year, but like you're talking frequently. As an advisor, it's funny because you can see the difference between someone who technically could have that more aggressive portfolio, but they're also the person that every few weeks are going like, should we get out now? Like I hear the CAPE ratio is too high, or I think the market's oversold or overbought, or it's too valuable. We should, they're asking the questions that make you go, we need more education here. Like the personality is really jumpy. And it's not like there's just some concepts that are just taking longer to understand and live through and experience. So as an advisor should be able to see that and go, even though you technically could have this portfolio, you're asking questions and we're having conversations so frequently that would indicate there's just a lower level of like understanding about how this works, that a bad market is really going to be too traumatic. It's going to be really trying for you. Yeah.
I think it can also, that's one side of a profile. Someone who doesn't quite have the understanding about how to get through a market, and they're going to just implode as it goes down because of fear or greed or lack of knowledge or information.
Yeah.
But there's also the other side that I feel like is also very common, which is someone who just trusts you and doesn't really ask questions. And so they're just like, whatever you say, Ryan, like, I'm just going to go with that. And
which is how I like my kids to behave.
Yeah.
They don't, by the way.
Yeah, they don't. No one listens to you. But if you, there are a lot of people who will just say, I will go with what your recommendation is.
Yeah.
And they will be fine. Like there's a lot of people that just really trust your recommendation. And I think that for the most part, if you're working with a good financial advisor and they are calculating your risk profile accurately on an account by account basis, and they know you really well, and they know your situation, and they know your cash flow, your debt, your goals, your practice exit time frame, how much you're going to sell it for, your real estate goals, like they can be trusted as a good resource for telling you what they think risk profiling should probably be for someone in your situation. And many times people won't ever pick up the phone. They'll just be okay. I have a lot of clients through bear markets who are just like, I know this, I'm fine. And their lack of interest or their lack of involvement or their lack of they'll still get scared and worried, but not to the point where they do anything about it. Yeah. They're just like, I know why I'm doing this. I know it's a cycle. I've been through one of these already. That can be good if you have a good financial advisor. It can be really bad if you have a bad financial advisor, because you don't really know if this thing's okay until the end. So just check your TT score, check the guidebook, make sure that your risk profile, that you're not withdrawing too much money out of your account, that your withdrawal rate's low, in the under 5% at a minimum, ideally more like 3.5% to 4%. And I think that way you can kind of protect yourself, even if you don't know whether your advisor is doing a great job or not. You could self-diagnose with that.
I think that's a great recap. I would just say, if you have questions and you want to, if you'd like to just ask us some of these questions, you want to check your TT score, you want to maybe just get another pair of eyes on.
Check your investment tilt and figure out if you should be more in stocks, more in bonds, what it looks like for your account.
Absolutely. Get in touch with us. You can go to our website, dentistadvisors.com, click the button that says book free consultation, and sign up an appointment on our calendar. You can call us or text us at 833-DDS-PLAN. Can they send like a picture text through that?
Yeah.
Have we tested that?
Yeah, you can.
Take a picture of your portfolio and be like, is this, let's talk about this. That'd be fine. So 833-DDS-PLAN. You can call us or text us, or go on our website, book a free consultation at dentistadvisors.com. I think that's a great place to end. Thanks, Reese.
Thanks, Ryan. Carry on.